Are you still building your Singapore portfolio around high-yield stocks, hoping those big numbers will give you steady, safe income year after year? Or maybe you're worried that some enticing payouts are just too good to last. In this video, we're going to pull back the curtain on this August top SGX Ex-Dividend stocks. You'll see which companies have true staying power, which ones are riskier than they look, and most importantly, you'll learn a simple 7-point checklist that'll help you spot the best dividend counters for real wealth growth in Singapore. If you want an SGX portfolio you can count on, one that maximizes solid recurring income and minimizes surprises, this is the only guide you'll need. Today, I'll break down the hidden levers that matter, go deep on the 5 counters going X in August, and share my own risk rankings so you know exactly where each stock stands. Hey friends, welcome back to the channel. I'm Iggy, and I cover all things investing, CPF, and wealth growth right here in Singapore. The Investing Iguana is proud to be ranked among Tiger Broker's top influencers, and you've helped us cross 1 million reads and 58,000 likes. I've produced over 900 videos and logged more than 500,000 hours of watch time on markets in Singapore and beyond. If you're serious about taking your Singapore investment journey up a level, you're in the right place. Here's what we're going to cover today, and you'll want to listen all the way. I'm sharing the real difference between headline yield and dividend quality. You'll learn how payout ratios can determine if a stock is safe or skating on thin ice. We'll see why free cash flow coverage matters more than any number you see on your broker's app. I'll break down the dangers of high leverage, especially important for yield hunters in this interest rate climate. You'll discover what earnings volatility signals about your long-term income prospects. We'll dig into the power of a proven dividend track record for CPF and SRS planning. And finally, I'll show you how to spot red flags before they wreck your returns. By the end, you'll know exactly which August Ex-Dividend stocks earn a spot in a proper Singapore portfolio and which ones to skip. So let's jump in with the most widespread mistake in the Singapore investing scene: chasing high yield without looking at what's behind it. As Singaporeans, we're drawn to big numbers. Seeing DFI Retail Group swapping 16% headline yield might make your eyes pop. But you need to ask yourself, is that payout sustainable, or is it just a one-off windfall? Will it help you build long-term wealth, or is it masking risks that might hurt you later? To help you sort through the noise, let's run through the key dividend shares going X in August 2025 and what sets them apart. Right now, Bukit Sembawang Estates is going Ex-Dividend on the 1st of August, paying a 4.7% yield with a super low payout ratio of 9%. And they've paid dividends for 26 straight years. Keppel DC REIT also goes X on the 1st, but gives 4.1% yield with an extremely high payout ratio between 86 and 112% and just 11 years of track record. Singapore Airlines, the airline that all of us know, is going X on August 8th, offering a 6.8% yield with a more balanced payout ratio of 42%. They've got over 2 decades of dividend history. United Overseas Bank, or UOB, is Ex-Dividend on the 15th. UOB gives a 5% yield, very steady, with a payout ratio just under half of earnings and a track record stretching back more than 50 years. DFI Retail Group is the outlier, going Ex-Dividend on the 21st. They show a 3% yield based on regular dividends, but a special payout this year takes the total to 16%. Yet, their core business has a negative payout ratio once you strip out that extraordinary dividend, and their 30-year record is shaky when you look closer. What does this tell us? Most so-called safe picks like B61, U11, and SIA are right in the classic 4 to 7% sweet spot beloved by Singapore income investors. But DFI's number leaps out and grabs attention, and that can be a red flag. Keppel DC REIT's high yield is less attractive when you see how much of their profits they're handing out, with little room for error. Let's go through the 7 crucial tests that every Singapore dividend payee needs to pass. First, look at the yield range. If you see anything above 7%, be wary. High yields usually mean something's wrong or unsustainable. It could be sector headwinds, aggressive accounting, or debt-driven payouts that won't last if borrowing costs rise. That's why B61 and U11's more modest yields are actually the safest bets over time. Second, Understand payout ratios. Bukit Sembawang's 9% payout ratio shows real discipline. They're only giving you a small slice of profits, keeping plenty in reserve for tough years. But when you see ratios above 80, 90, or even 100% like Keppel DC REIT, that's a warning they're drawing down reserves or even borrowing to fund distributions. Third, cash flow coverage is key. It's like lending to a friend who consistently has spare cash versus one who's robbing Peter to pay Paul. If a company's free cash flow doesn't cover dividends by at least 2 times, especially for REITs this year, you could be setting yourself up for a future cut or disappointment. This is where UOB shines. Semi-annual dividends covered by stable, well-provisioned, local banking profits. Now, if you're following along and want a deeper dive into the tables, the full data, and more visuals, make sure to check out our Investing Iguana Substack post linked in the description. There's plenty in there that'll help you drill down into every metric. Fourth, let's talk about leverage. High dividend companies sometimes bulk up their yields by running heavy debts, thinking everyone will keep lending regardless of macro conditions. But rising rates punish these names first. Bukit Sembawang has no debt, an incredible feat for a property developer in Singapore, and that gives them the flexibility to ride out turbulence and even grow payouts over time. Fifth, you must watch for earnings volatility. Imagine your salary swinging by 50% every year. Tough to plan or sleep well at night. Airlines like SIA give out higher dividends now but could see sharp drops if conditions change. Banks and developers with stable cash flow, such as UOB and B61, reduce your risk of a nasty surprise. Sixth, track record is everything when it comes to CPF and SRS plans. Investors who rely on those payouts in retirement need companies that have already survived downturns, new taxes, even policy shifts. Only shares with a decade or more of steady dividends, and some, like UOB, putting up 50 years, are truly fit as core portfolio holdings. Finally, you have to look for those subtle red flags. Sometimes the payout looks fine, but management is masking ongoing sector decline, or they're only propping up the numbers with asset sales or irregular special dividends. With DFI, the special payout draws many in, but their fundamentals don't back up a case for a mainstay holding. Put all these factors together and you get a clear picture. Bukit Sembawang and United Overseas Bank come out on top, each scoring between 6 and a perfect 7 on the durability scale. Keppel DC REIT and Singapore Airlines are reasonable tactical positions, but need extra caution. Both have meaningful question marks about consistency. DFI may pay handsomely this year, but it's strictly for tactical, speculative plays, not the foundation for long-term income. So what does this look like in practice for your investment objectives? For steady income, anchor your CPF and SRS around safe names like B61 and U11. If you want growth, build on these bedrocks and layer in SEA for higher, but bumpier, returns. If you like REITs but can't stomach too much risk, watch Keppel DC and only enter when you see payout ratios moderating back to 80% or lower. If you're the tactical, go for the special type, DFI's windfall may be worth a nibble, but never let it become more than a small satellite stake. Let's fit this all into the bigger Singapore context. Recent CPF changes mean you can save more and get higher lifelong payouts, but the secret is pairing those policy shifts with true dividend reliability. After you turn 55, the closure of special account will shift some funds and maybe your flexibility. So double check your holdings are set up for more money moving to ordinary or retirement accounts. And for SRS users, you're looking to get every dollar you can without extra tax, so stick with consistent payers and ignore the temptation of one-hit wonders. Now here's my personal outlook. After watching these markets for decades and seeing hundreds of cycles come and go, real wealth for Singaporeans comes from discipline. When you settle on proven CPF and SRS core holdings with conservative payout ratios and cash flow you can trust, you'll sleep well through market storms and earn that reliable compounding you need. Tactical, riskier yield has its place for spice or opportunity, but your foundation is everything. The bottom line, don't be distracted by which stock shouts the biggest number today. Give your future self the gift of steady, rising, and covered payouts over time, and keep reviewing every quarter for red flags, coverage, and debt. Diversification and discipline have never been more important. So we've broken down the 7 keys to Singapore dividend durability, ranked the major August ex-dividend names, and I've shared my personal approach to building a CPF smart SRS ready portfolio. If this video helped clarify your Singapore income investing, please like the video, share it, and subscribe to the Investing Iguana so you never miss the next post. And for those who want to truly stay ahead, premium members get first, exclusive access to every video. That means my urgent alerts and deeper research hit your inbox before anyone else sees them, sometimes a whole week in advance. It's less than your Copia toast box, only $1 a month for a major edge in making smarter, faster investment decisions. To join, just click the premium link in the description and unlock next level investing today. And if you're hungry for more, watch our previous episode on building reliable CPF income streams for 2025. It's packed with strategies you can use right now. Stay smart, invest steady, and I'll see you in the next one.